We can broadly classify those risks as a domestic risk. And if we have global operations, then we can also classify another kind of risk as international risks. So international risks will involve what happens if, let's say, your company is doing business in China or in Hong Kong, in Europe, and it is exposed to those different currencies. So how the fluctuation in the currency gonna impact to your business or your profit? In domestic environment, there are various risks associated. For example, you are operating in a building or the building collapse, or let's say you hire people and knowingly and unknowingly your employees are not happy with you and they sue you in the court. Okay? So that's sort of kind of to give you a sense what kind of risk may be. So it is very difficult to see what going to happen in future. Of course, nobody knows what's going to happen tomorrow, right? So that's where the risk factor comes into picture. Is in other words, if I ask with you how long you're going to live, right? So you may have some expectation, oh, I'm going to live for 40 years, 50 years, 100 years, but nevertheless, there is a risk. And for that risk, you guys go and, buy a life insurance policy so that if you are no more there, your dependent or your family or kids, if you have kids, for example, they can get benefit. Or let's say simple unemployment insurance, for example. So nevertheless, there are risks. So as a risk manager in a company, what you should be looking at? So you should first understand what are the major risks and possible consequences my firm is gonna have because of those risks. So important point here is to identify various risks, and if we can identify, definitively we can put some measures in place to minimize those risks. Okay. Another important question comes into mind, that is the firm being paid off for taking these risks? Or in other words, you can say that in a company you have different managers who are managing different departments. So if they do not manage the risk at an independent departmental level, think about what's going to happen to the overall risk of the company. Okay, so it is always a good idea to manage risk at a individual department or business unit level. Now, if there is no incentive for those managers to manage the risk, they will not do it. Okay, so they've got to have some sort of incentive for those managers to manage risk at business unit level. Okay. Another important point you should be thinking that how we can control these risks. So once important aspect is the identification of the risks, whether it's domestic risk or international risk, right? And then once you have identified, then what are the measures, control measures, or what can you do for this risk? Simple enough. Let's move forward. Let's try to understand basic concepts, or what instruments are available, okay, in terms of financing, right? There may be different risks, say project risk or related to at independent business unit level risk, but we're not going to go in detail about those risks. So here, the important idea as a finance person, okay, to look at the risk from a financing perspective, or you may say you should have some basic idea. What can you do? Okay, so let's talk about contracts for managing risk. Okay, for example, You may fix the price of raw material. Okay? For example, you are a manufacturing company. Okay? You are manufacturing, say, kids play items, or in simple sense, let's say toys. You're CEO of a toy manufacturing company, and you're getting some raw material, and your firm is finishing that product and selling in the market. So what can you do for the input material price change? That you can say to your suppliers, okay guys, we're gonna fix the price for at least for this year. So you have minimized that risk. In the same way, let's say you own property, okay, and you wanna rent that property out. Now, there can be risks associated with that property. Say, for example, if you are living in a big condominium building where the same building is shared by hundreds of other families who are living in the same building, and your condo is in the middle of, at some floor, and if something happens in your unit and which is affecting the other unit, you have to pay for it. So there are different sort of risks associated with the building, and even with the tenant too. Let's say tenant does something in your unit and which is affecting the neighbor units. So what can you do? Okay, so legal liability can be huge in North America. So you buy a tenant insurance, okay? And also you get some post-dated checks from the tenant. It's sort of a minimizing the risk that tenant is gonna be there for at least a year if tenant is signing up a lease, and taking post-dated checks makes sure that you get your payment every month in time. So it's sort of a very simple example how you are minimizing risk at a day-to-day level. Now, if we go in a bit more to discuss about insurance, well, insurance is a very big thing. It's like a giant monster in North America. There are insurance policies or different kind of insurance, for example, theft, fire, accident, legal cases, property insurance, project insurance, vehicle insurance, etc., etc. Simple. Let's say you cannot drive car without a car insurance. Think about it. Insurance is really a monster in North America. So beware of it, the insurance monster. And it happened to be, for example, if it happens that you are working for an insurance company, well, you already know how big is this monster. It made many people billionaire in the world, and many big companies are in insurance, which are in the Fortune 500 list, top 2 or 3 places, I guess. So you can think of the big monster insurance, right? Now, what can we do? What kind of tools do we have for managing risk, or let's say hedging the risk? Okay. Well, a fancy name comes to mind called derivatives. So you guys might have heard derivatives, derivative instruments, foreign exchange trading, high frequency trading, and you guys I wanna go to, finance industry, quantitative finance, whatnot, and play around with derivatives. Well, that's fine, but let's try to understand the basic idea behind derivatives. So as it happens to be, in a survey, it is found that 85% of Fortune 500 companies, they used interest rate derivatives, or hedging the interest rate risk, they used derivatives. 78% of Fortune 500 companies, they used in some way the derivatives for hedging the currency risks. And 24% companies out of Fortune 500 companies, they used derivatives for hedging towards commodity risk. So think about derivative. It's a very fancy name, but a very, how do I say, um, it's a kind of, um, I'm trying to put it in words, um, because it goes in the line of speculation. And it's again getting into that territory, but nevertheless, it's like atom bomb. That's the correct word in finance area. Derivatives are atom bombs. So let me write it here. Um, like in physics, or in science, you call it atom bomb. Okay. Now in finance, derivatives are atom bombs. So remember this thing. So be very careful when you are involved with derivatives in your life. Atom bombs. Okay. Let's try to understand how hedging can help us to reduce risk. Okay. So as we already know, we have derivative instruments, or we can call derivatives simply uh, options, for example, forwards, futures, swaps. Collectively, we can call them derivatives. So let's try to understand options. We learned about options in previous lecture on corporate finance lecture series, but here, just to remind you guys that what do we mean by option. Let's say you are a CEO of a big oil company, okay, and you wanna reduce your risk towards the fluctuation in the oil price. Okay, so ideally you have some sort of idea in mind that we want to fix the price $50 per barrel, or you did a study in past years and you say, okay, in January we should be selling at $50 per barrel. If it goes up, it's fine, but if it goes down, then you're going to be losing money. Okay, so not to lose money, what we can do here, so if we want to sell, say, 300 millions of barrel of oil at market price, means just $50, which we are expecting, then we would be making $15 billion in revenue. Okay, but price may go down too. So if price goes down, what we can do? Well, let's try to see what we can do. Simply buy put option. Okay, so put option will give us right to exercise if price goes down. Say we buy put option at $50 exercise price and the oil price goes down to $40. But we don't have to worry because we already are in agreement with that option, put option, that we will exercise at $50. So we are safe there. So we are safe. So buying an option, it is basically putting us safe that whatever we thought that market price is 50, if it goes down, we are not losing money. And if it goes up, we are just simply making money. So overall, the revenue, what you can see from this chart, that if it goes down, we stays at the same level. If it goes up, we make more profit. So how we have used put option to hedge against oil price risk. Okay. Now let's talk about forward and futures. It's a quite fantastic concept, but nevertheless, these are just the different names for the same thing. Let me put it that way, and we're gonna know how it is. So let's take an example of King Oil distributor. So these examples are hypothetical example. So let's talk about the King Oil distributor. It takes oil from a refinery and distribute to um, individual people or in retail. Okay, so it takes oil from Lequator refinery. Hopefully in future this refinery exists, but it's an hypothetical example. So Lequator refinery gives oil to King Oil distributor. Okay, and King Oil distributor distributes to its retail customers. Now think about, this is the time in September. Okay, and people at King Oil distributor think that, okay, this year it's gonna be too cold, so demand for the oil may increase. Okay, so as the rates may increase, and we may not get good deal from liquid refinery. So what happens that the King Oil distributor, it signs up a deal with liquid refinery in September. Okay, that it agrees to buy 5 million gallons of oil from liquid refinery at a price of 35.5 per gallon, right? To be paid on delivery in January 2016. Okay. So liquid refinery will get paid in January in future date. However, both parties, they signed up agreement in September. So see here, the payment and the selling of the asset is happening in January, but the deal happened in the past date, in past time frame. Okay, at the past date. So what we can say here, the King Oil agreed to buy in January. We say that King Oil has long position in contract, and Liquid Refinery agreed to sell in January, and it has short position in contract, and we call this a forward contract. Okay, and the price at which they agreed is called forward price. In the same way, we have spot price. Spot price is nothing but the price for immediate delivery. For example, whatever the price is now in September time frame, that is spot price. Now forward price and spot price are linked together with a mathematical equation. How we solve it is future price Ft equal to spot price multiplied by 1 plus RF risk-free rate minus yield or interest rate whole to the power t time frame. Okay. Now think about, they signed up a deal, Liquid Refinery and King Oil. Liquid Refinery is very big, but King Oil is not that big. So King Oil is still kind of, thinking again that I signed up a deal, but is there any way I can get out of that deal? Because what happens that if the price gets up and down, and if it goes on the other side, I might lose money. So King Oil see that thing, and that, okay, is there any way to get out of this contract? Well, there is sort of some way. It's not exactly getting out, but it's some way that what if that contract is traded on an exchange? It's like a stock market, or you buy and sell shares. So what if we buy and sell the contracts? Okay, forward contracts. Simply, so King Oil goes to marketplace. Good. Now in same way, Liquid Refinery also may go to marketplace, and when these go to marketplace, we call it a futures market or futures exchange, and simply the forward contract takes a name as futures contract. Isn't it fascinating that both things are linked together? It's just a fancy names. All right. So that's a concept of forward contract or futures. Okay, and you can trade those contracts on futures exchange. what's commodity exchange, for example, is nevertheless, you can flip around the words, terms, but same thing. Okay. Now let's talk about swaps. It's very interesting what swaps are. You might have still have memory of 2008 Lehman Brothers crash. Big investment bank crashed, got bankrupt. Why? In the end, it turned out to be they did the bad swaps. Okay. Now those swaps were different, very complex swaps, but here we're gonna get a simple idea about what swaps are. Okay. So let's talk about interest rate swaps. Let's take another hypothetical example of H Bank Corp. Okay. So H Bank Corp finance the housing project of quarter homes. Okay. Uh, and the deal is that the H Bank Corp is going to give $80 million loan to quarter homes at a fixed interest rate of 8%. Okay. And it is for 5 years. Good. Now, how much annual payment quarter homes is going to make to Bank Corp is simply, you just simply multiply 80, because you took the loan $80 million multiplied by whatever is the interest rate per year, 8%, 0.08. So annual interest payment would be $6.4 million. Good. Now, H Bank Corp tells or says that, no, what if I want floating rate payments? So they issued, H Bank Corp issued a loan at a fixed interest rate. But later on, they say to themselves, or they make a scenario, what if we can have a floating rate payments? And how we can do it? Well, the option is swap. Just simply swap. Swap the $6.4 million yearly fixed rate payment with a floating rate payment. Okay. And how do we do that? Well, let's say Bank Corp can borrow at a rate 6% from a big bank or investment bank or from somewhere for 5 years. Good. Now that 6.4 million interest payment which H Bank Corp is going to receive from quarter homes, okay, it can support a loan of 6.4 divided by 0.06, 106.67 million. Okay. Bingo. Now it can create a swap. Let's call it quarter home swap. So what it is, it just borrow 106.67 million at a fixed rate 6% for 5 years and simultaneously lend the same amount at LIBOR floating rate. And LIBOR floating rate is nothing but it's an interbank floating rate at which the banks give loan to each other. The term basically came from London Interbank Offer Rate. Okay, good. So what happens? The H Bank Corp, small company, goes to a big investment bank and say, guys, let's do the swap. Okay, that is called fixed to floating interest rate swap. Okay, and 106.67 million is known as the principal amount of the swap. Okay, good. So now let's try to work out in terms of numbers how it's going to work. Good. So what happens that at the Zeroth means present time frame, okay, current time. We borrow, okay, so whatever money, 106.67 can be supported by your interest payment of fixed interest rate from quarter homes. Okay, we borrow same amount and we lend same amount, okay, at LIBOR floating rate. Good. So we have net cash flow 0. Now, at the year end, what's going to happen? We're going to receive $6.4 million and we have to make payment for the money which we landed at the LIBOR floating interest rate. Okay, so we're going to receive that money which we landed actually, because we borrowed at 6% fixed rate, but we are going to land at a LIBOR rate. Okay, so that's what amount we will get. Now LIBOR floating rate gonna change every year. So see how the bank is smart, how they are doing. They are basically hedging or taking the benefit of that speculation that interest rate gonna go up. If it goes on the other side, they're gonna lose money. But they are thinking that it's gonna go up, floating rate, because they might have studied what happened in the past years, and they're comfortable with it to make some extra money. Good. So as you can see, at the year end, minus 6.4, that's basically out, which and we are assuming here the 5%, okay, the current LIBOR interest rate is 5%, okay. So at the year end, that much would be the cash flow. Okay. So in the same way, we can calculate the cash flows if we know the future LIBOR exchange rate. Don't worry about my pronunciation of LIBOR. Here, important thing is to understand the concept. Okay. So now let's try to work out. At the end of the year one, the bank corp, or say let's say IB, investment bank, which is acting as a dealer, it is supposed to pay, okay, at 5% interest rate multiplied by 106.67, 5.33 million to H Bank Corp. Good. And H Bank Corp, it is supposed to pay 6.4 million, basically the fixed interest rate payment what it got from Quarter Homes, to an investment bank. Good. Now, how much net payment Bank Corp is going to pay to IB is simply 6.4 minus 5.33, 1.07. Good. At the end of the year one. Now, let's say that at the end of next year, that LIBOR, LIBOR, LIBOR X, the interest rate goes up, okay, goes up to 6%. So now if it goes up to 6% and next year, let's say 7%, okay. So if it keep going up, then essentially the H Bank Corp is going to make some extra money, and which is how much extra money going to be? That cash flow which is depicted by this equation. Okay, so let's see what happens at the end of the year 2. Okay, as we said, interest rate is 0.6, so it basically doesn't make any payment to investment bank. Good. So same way we can do calculations, and so that's basic idea about how these swaps they work. Good. Now let's try to understand what are currency swaps. For example, a big multinational company, they need almost they need let's say they need 11 million euros to fund a project in Germany, for example, and they are sitting here in Canada or in United States. Now, so I'm going to take an example of the US dollar versus euro. So think about the companies in United States. Okay. So instead of directly, getting into, get the money here, $10 million, and convert it into euro. So the $10 million, if company borrow in states, is gonna be just 8 million euros as per the current exchange rate. Okay, but can we do better? That if we have a partner, or if we have an bank or investment bank which can do swap with us, that it provides money in terms of euros to fund our project in Germany. Okay, so can we do something to minimize our losses because of the foreign exchange rate? So as for an example, let's say we can borrow at a rate of 6% in the States, and in Germany 5%, in terms of euro. Okay, so let's see how it's going to work. So simply the swap issue, the company issues some sort of instrument, or let's say notes. So company issues the notes, or even go for bonds. So in some form of company arranges financing. Okay, so it takes the loan in terms of US dollars. Okay, and it swap dollars to euros. Okay, so $10 million, 10 million US dollar, and in the beginning we just get $10 million and pay to our partner, who is going to provide money to in Germany in currency euro. Okay, so think about Rothschild Group. I just remember that story, that the currency or this kind of hedging, they started by Rothschild. It might not be very popular at that time, but Rothschild Group, they 5 brothers, they were sitting at 5 centers. One was in Germany, one was in France, one was in London, UK, one was in Austria, okay, and one was in Holland, if I'm not wrong. So 5 major financial cities in Europe, 5 different countries. And if government needs money to fund their war projects, let's say in UK, okay, and they say, okay, we're gonna fight a war in Germany, and we need to pay our soldiers in form of German currency. Can you do that? So what Rothschild were doing, okay, yeah, sure, we will pay you in German currency. I just need to call my brother who is sitting in Frankfurt, and done. Okay, so what they were doing nothing but they swap. Okay, so we've kind of made a concept. It's a very old concept, but in modern terms, let's keep our discussion continue further. Okay, so our partner, it gives us $8 million in euro. Okay, so this is at the year 0. We don't have any cash flow in dollars, and in euro we got 8 million euros. Okay, now year 1 to 4, because we can we loan, let's say 6% interest rate in US dollar, we have to make payments, so it's basically $10 million. Okay, and how much we have to pay back, interest rate payments 0.06, so we pay 6 million, okay, all right, to our partners for swapping. And what happens that at the year 5, all right, so at the year 5, um, we basically, you can think of that, we end up converting our $10.6 million to 8.4 million euros. So you can think of in that form that how this swap helped us. Okay, now how much our partner is gonna pay, because he also loaned money at 5%, so it's simply 8 multiplied by 5, 0.05, 5% interest rate. Okay. So see how currency hedging or currency swaps helped us. Otherwise, we would have been paying 10 million US dollar to 8 million euro. Here, we sort of hedged, and after 5 years, including the interest payments, we basically got 8.4 million euros for our German operation, okay, German project. So good, that was the basic idea about swaps. If you need to know more about currency swap, it's a very vast area. Swap are kind of fancy instruments. These are derivatives, and as I said earlier, be very careful. These are atom bombs. Okay, so you can read more in detail, but the idea for this lecture is to give you an overview about these concepts. Okay, now let's talk about how to set up an hedge. Okay. So we know different instruments, but what we are doing here. So what hedging means? It simply means that buy one asset and sell an offsetting amount of another asset. That's what we are doing here. That's what the hedging is doing, which is sort of minimizing our risk. Okay. So let's say you own an asset A. Let me call it soybean. Okay. So you are a farmer. You have a big farm and you grow soybean. You own that asset, but you don't control the price of soybean. So what happens if the price goes down? So how can you hedge the risk which is due to price fluctuation for soybean in the market? All right. So let's say another asset called soybean futures. Okay. So what you're gonna do is simply that the change in the value of A is equal to A plus delta and change in the value of B. Okay. So what you are doing basically, you are selling an offsetting amount from soybean futures, okay, towards hedging the risk for asset A, that is soybean rates, right? And the delta, small delta here, it's called hedge ratio. Or in other words, it measures the sensitivity of A to changes in the value of B. Okay. Now this is quite difficult to get hedge ratio. There are different models, quantitative techniques. If you say, for example, if you have past data, you can apply statistical formulation or models. So it's kind of quite tricky to know hedge ratio. So as you can see that the whole derivative area or these instruments are quite risky, okay, and this goes to more in the speculative area. What happens? Your speculation turn out to be the other way around. Well, it's gonna give you great losses too. So it depends. It depends how good you are in speculation. So accordingly, you will fit those values in your mathematical model, and if the values are good in your mathematical model, you will make good profit. Okay. Nevertheless, remember that derivatives are atom bombs, right? So, all right, guys. Thank you very much for listening me, and thank you for subscribing the Professor channel on YouTube. Those who have not subscribed, please do subscribe the Professor on YouTube. If you like this lecture or other lectures on LeProfesseur channel, please click on the like button. That encourages us. Also, it improves rating of our videos. Thank you once again and have a wonderful day.